This is John X. And if you were watching gold or silver at the COMEX Open this morning and felt that shift, that specific, unmistakable sense that the market just made a decision, you were not wrong. This was not a thin, overnight move. This was not a headline spike in the London session. This was New York. Full liquidity, full institutional participation, full price discovery. And what the market told us in the first 30 minutes was not noise. It was a statement. Gold opened and held $5,400. Silver pushed to $96 and held structure above it. The COMEX floor did not flinch. It repriced. And today, for the first time on this channel, we're treating the COMEX Open itself as the primary event, not the macro backdrop behind it. Because what happened this morning was not a reaction, it was a confirmation. This video covers exactly what the $5,400 gold level means structurally right now. Why $96 silver tells you more than the $100 headline everyone keeps chasing. What the first 30 minutes of COMEX order flow actually revealed. And one positioning detail that most metals holders are completely overlooking this week. All of it. From open to close framework. Stay with me. Before we get into it, hit subscribe right now and turn on the notification bell. I am covering this market every single day while these critical levels are being tested. Not weekly recaps, not hindsight breakdowns, daily structural analysis. Because the information you need at $5,400 gold is fundamentally different from what you needed at $4,800. If you are not subscribed, you will miss the transitions that matter most. Hit the like button, and as always, educational analysis only. No courses, no paid signals, no financial advice. Do your own research. Consult a qualified professional before making any investment or tax decision. Let me start with gold. And I want to be exact, because precision is what separates real market understanding from emotional headline reading. Gold at $5,400 sounds like a breakout. It is not a breakout. It is a test. Gold's confirmed all-time high on the spot market remains $5,523, printed on January 29th. That level is the ceiling that matters. What happened this morning is that gold reopened within striking distance of that high, absorbed selling pressure, held structure, and did not collapse. That distinction is not semantic. That distinction is critical. Gold entered January at approximately $4,536. By January 29th, it had climbed to $5,523. That is a 22% move inside a single calendar month. A vertical expansion phase driven by four converging forces simultaneously. Dollar weakness, central bank accumulation, rate expectation shifts, and escalating geopolitical premium. When those four forces align, gold does not walk higher, it moves. And it moved. Then the market did what it always does after vertical expansions. It consolidated. The pullback from $5,523 into the $5,100 range was not a breakdown. It was digestion. Through February, gold built structure. Higher lows, cooling sentiment, quieter headlines. That kind of consolidation is what gives today's $5,400 level its weight. Because this morning was not panic buying. It was structured recovery inside an existing bull cycle. Those are two completely different things. At $5,400, gold is sitting approximately 2% below its all-time high. 2%. In commodity market terms, that is one strong session. That single reframe changes how you read everything else. The question is not whether gold is in a bull market. The question is whether today's COMEX Open marks the beginning of the push that closes that final 2% gap and puts the record under direct pressure. Now, let me tell you what the Open actually showed. The first 15 minutes of COMEX trading printed aggressive market buy orders, lifting offers above $5,380 with minimal retracement. When price moves through resistance and does not pull back immediately, That is not retail momentum. That is absorption. Institutional players were taking the other side of short positions and holding. That kind of tape behavior does not come from sentiment. It comes from positioning. And positioning at this level means someone with serious capital made a deliberate decision this morning, not a reactive one. The macro backdrop behind this move did not begin today. The US dollar index remains under 99, down materially over the past 12 months. A structurally weakening dollar is a persistent tailwind for gold that operates completely independently of any single news event. Major institutions price gold against the dollar first and headlines second. That relationship has not changed. It is not changing. Large wealth managers are already positioned for significantly higher gold into 2026. UBS projected gold reaching $6,200 per ounce earlier this quarter, based on dollar weakness, sustained central bank demand, and macro positioning. That forecast was not built on today's open. It was built on structural forces already in motion. Today's COMEX confirmation layers on top of that structure. It does not replace it. And when structural forces align with strong institutional tape behavior, the pathway toward the previous high becomes less theoretical and more mechanical. Now bring silver into the analysis, because $96 silver is not a footnote. It is the tell. Silver at $96 is not simply a price milestone. It is a ratio signal. Over the past 12 months, silver's percentage gains have outpaced gold by a significant margin. That outperformance is not coincidence. Silver is functioning simultaneously as a monetary hedge and a critical industrial input. Two independent demand engines, one price. That structural duality is what makes silver's move at this stage more significant than the number itself. The gold to silver ratio right now sits just above the mid-50s. That number is not trivia. It is a pressure gauge. When the ratio compresses toward 55 and below, silver historically transitions from following gold to leading it. Leading means acceleration. Leading means volatility expansion. We are within a narrow band of that threshold right now. Watch that number this week. Not passively, intentionally. Because when ratio compression aligns with strong COMEX buying in both metals, the character of the entire precious metals market shifts from defensive positioning to offensive positioning. Here is what most headlines will not tell you. Silver's all-time high sits materially above $100. Gold is 2% below its record. Silver is not. That gap is not a weakness. It represents relative asymmetry. When both metals are rising simultaneously, but one remains further from its historical ceiling, capital rotation becomes a logical allocation conversation. Not hype, not speculation. Arithmetic. If this breakdown is giving you clarity that the headlines did not, hit the like button right now. That one action tells the algorithm that serious investors are paying attention to this level of analysis. Hit it now. Now, I want to address something that becomes extremely relevant when gold is pressing $5,400. And it has nothing to do with chart patterns or price targets. It has everything to do with structure. Many investors hold gold exposure through vehicles like Spider Gold Shares. GLD is one of the largest gold ETFs globally. Deep liquidity, tight tracking, convenient access. But it carries a tax classification that a significant number of holders have never fully reviewed. GLD is treated by the IRS as a collectible. Long-term gains can be taxed at rates up to 28%, regardless of how long you have held the position. At a moment when gold is pressing all-time highs and unrealized gains on long-term positions are substantial, tax treatment is not a footnote. It is a material variable in your actual return. There are alternative structures, including physically backed trusts like the Sprott Physical Gold Trust, which under specific elections can qualify for long-term capital gains treatment instead of collectibles treatment for U.S. investors. The classification matters. The form matters. The mechanics matter. On a six-figure position with meaningful appreciation, the difference can represent thousands of dollars in real money. That is not theory. That is arithmetic. When price is at $4,000, fewer people run the numbers. At $5,400, you should run the numbers. Now let me give you the week framework. Gold holding above $5,350 through midweek signals structural continuation. A daily close above $5,450 puts direct pressure on the $5,523 record high. Silver holding above $94 through midweek keeps ratio compression active. A decisive push through $97 opens psychological proximity to triple digits, and psychology matters in commodity markets at inflection points. Midweek economic data will test whether this move is safe haven-driven, inflation-driven, or both simultaneously. A dual-driver environment, geopolitical premium plus inflation hedge demand, is a different animal than either force operating alone. Watch how gold responds to that data in real time. There is also a scenario where both metals pull back this week. Markets do not move vertically without pauses. If dollar strength briefly returns or macro headlines soften, gold could retest lower support while maintaining higher structure. Silver could pull into the low 90s without breaking the larger trend. Neither of those scenarios invalidates the thesis. They reset positioning. The structural case for gold remains dollar weakness and central bank accumulation. The structural case for silver remains industrial demand and constrained supply dynamics. Today's COMEX Open did not create those forces. It revealed them. Drop a comment below with one word: gold, silver, or both. 3 seconds. It signals engagement. It tells the algorithm that serious market participants are watching this channel and taking this analysis into their week. If this video gave you one framework you did not have before pressing play, hit the like button. It costs nothing. It may help another investor understand why $5,400 is a test and not just a headline. Share it with anyone holding GLD who has not thought about structural tax treatment at these price levels. They deserve the clarity. Subscribe and turn on the notification bell. Tomorrow, we go deeper on ratio compression and track whether today's COMEX strength carries through to settlement. This channel is OG John XX. I am John AG. Day one at $5,400 is on record.